All right, when you die, do you lose all of your cash value? It's a common question that comes all the time. When people are looking at YouTube, like you may looking at right now, you see a lot of people out there on the internet share when you start looking at whole life insurance that it's a scam. When you die, you lose all of your cash value and all you get is a death benefit. What I'm gonna do is I'm gonna show you the numbers, and at the end of the day, I'm gonna let you decide what you think and kind of share the facts and figures on what it is that we're looking at. With that being said, I'm gonna go ahead and share my screen. All right, so here's what a policy can look like for someone that is the age of 35 years old. This is age 36 at the end of the year, right? They're putting in $100,000 a year into the policy. So it goes up 100, 200, 300. Here's their total cash value that they have the ability to borrow against and use whenever they want access for opportunities, real estate, business, emergency, so on and so forth. What you're going to see is that the death benefit over here is $2,566,000. So when we're looking at term insurance, right? Term insurance is essentially like renting a home. You pay dollars towards it, and then at the end of the term, you no longer have any type of money. You don't have any type of equity. You don't have anything to your name except that you've had protection, right? In the term perspective pace, you had protection. In a home perspective, you just had a place to live, and then that's it. When you buy a home, you obviously are paying a mortgage that builds up equity. And the same thing when it comes to this. Whole life insurance allows you to put money into a policy, build up equity, and you now own the policy to where you have a death benefit permanently for the rest of your life. So that's kind of a conceptual play to think of it as term versus permanent, is that term is more like renting, permanent is more like owning a home. And when we have a term policy, you have a set premium. So we'll just say it's $100 a year or $100 a month. $100 a month for an entire year is $1,200. At the end of that term, which insurance companies will only pay out about 1% to 2% of the time. They have done the math actuarially where they will insure you to where they know that odds are you are not going to die. So those policies will only pay out 1% to 2% of the time. So at the end of that term, that 30-year term, you no longer have those dollars that you lost that you could be used compounding somewhere else. And at the end of the day, there is no cash that's built up point blank. Now, when you have a term policy, the death benefit stays constant. So if I'm paying $100 a month, $1,200 a year, let's say it's for $1 million of death benefit, okay? You have $1 million of death benefit that stays constant for the full length of time. It could be 10, 20, or 30 years. We'll just say it's 30 years, length of time. Does not change, okay? Put in $1,200, I have this protection. My family's protected for 30 years, so on and so forth. In this policy, you will see the death benefit here is $2,566,000. The second year, it goes to $2,847,000. All right, I'm no math genius, but if I look at the difference between this year and this year, well, now I have about a $200,000 to $300,000 difference. It's about $280,000 difference between the two that it went up and increased. So I put in $100,000. I have $2,566,000. I put in another $100,000. My death benefit increased by $300,000. I do it again. Put another 100, increased by another 300. I put in another. It just continues to go up and continuously in perpetuity, always increasing. Your death benefit will always be larger than your cash value. Now, here's something to consider. If I were to die day one, is that the most benefit time to die? Of course, right? You have the ability to earn a really, really high rate of return if I put in $100,000 and I get $2,566,000 back. But the odds of you dying at the age of 36 is very unlikely, right? So we can scroll down and we can see over a period of time, right? Let's just say the average age of death is about 85 years old. You see there's about $18 million of death benefit that essentially is in there for you and your family when you do die and pass away. So there's going to be a point in time when you die, we all do, 6 feet under, so on and so forth. Your total cash value here is $15,745. So if you were to die at age 85, how much money would you get back? Would you get this $18,660,000? Would you get this $15,745? Or would you get both of them? Right? When you look at this firsthand, you would think, well, I would get both of them, right? Here's my cash value column. That's growing and increasing over a period of time. And then also here's my, death benefit. There's $20 million. We're looking at this number, $18 million. I should get both. So a total of $30 million plus that I should be able to get and pass down to my family. But in reality, what actually happens is, yes, the death benefit is the only thing that actually gets paid out to your beneficiaries. Now, here's something to think about. The death benefit is for when you die. The cash value is there for when you live. Okay, so they're the same. They work together. They are one with each other, but they are meant for two different reasons. Okay, so when we're alive, we want to be able to use and borrow these funds here to be able to borrow for real estate, investing opportunities, to grow our wealth other places, to produce cash flow, to increase our lifestyle, to live an intentional life. This death benefit is here for protection and also for a legacy perspective. It could be for estate planning, it could be for whatever purpose. Now, here's how this works. If I'm in year 5 and I borrow $500,000, because that's what I have, $501,000. I borrow against. So I have access to $501,000 and I borrow the full $500,000. Now my death benefit is $3,200,000. It subtracts the cash value from the death benefit. It goes to $3,200,000. If you were to die in year 5, you now only have $3,200,000. So they are one within each other. They work together co-tandemly. So when someone says, do I get one or the other? Well, from the very beginning, they are pieces of each other. They work and operate together. They both are continuously growing. And when I borrow against my policy, well, then I have less cash value. You're essentially using your death benefit as the collateral piece to be able to have access to your cash value. And they'll give you a line of credit up to the amount of cash value that you have available. So when someone's asking the question, well, you're asking the wrong question, because from the get-go, they're not essentially two separate entities. They are one, but they're used for different things. One's for your death and one's for alive. And I would never complain in any instance of if I put in $1 and I essentially had multiple dollars back. So I put in 100,000 and I got 300,000. So I put in $1, I made $3 back to my legacy perspectively, right? I do it again. I put in another $1 and I make another $3 back from the death benefit perspective, right? In the term insurance, I put in $1, I don't make any money. The death benefit stays the same, right? So that is one instance where the death benefit is separately from the amount of premium that you're paying as the term insurance, but the total dollars that you're using in here, putting into your cash value, is essentially a piece of the total death benefit. They are working together as they both continuously grow over your entire life. So I hope that helps give you a better idea of, do you get one or the other? The answer is, if you're looking at it from a numbers perspective and you see one column and the other, the answer would be, yeah, you only get the death benefit to your family. But if you understand how this works and how it's designed, the understanding is no, like, you're not getting just one or the other, because they work together at the end of the day. Hope that helps, and stay tuned for the next video.
Thank you so much for watching this video to the end. This video is on life insurance, and if you have more questions about life insurance, infinite banking, why you should overfund it, we have a link below that goes to our And Asset Vault. This is a free vault that gives you everything you need to know about life insurance. We have case studies, we have a calculator on there, we have a handbook, we have frequently asked questions, we go through a process. I have my masterclass on there. We literally want to be the one-stop shop for every life insurance decision. And so if you want to learn more, click the link below, and we look forward to educating and maybe opening your mind and eyes to the power of life insurance.